to talk about what we call market structures. Every firm participates in a market. Market, by definition, where buyers and sellers come together to buy and sell products, right? Market structures are what we're going to cover the next 2 weeks. Chapters 9 and 10 you will do together next week. I've done an abbreviated 9 and 10 for you. That will all be over market structures. Market structures, it's basically the attributes of the market that you as a firm have to function in. And you need to know those attributes, and you need to know the type of market structure that you're in order to figure out how to profit maximize in that structure. Which we talked about, micro is all about profit maximization. It's why you take microeconomics, so we can teach you how to profit maximize, okay? So the first of the market structures, the most basic, sort of our base level market structure is what we call perfect competition. It's a little theoretical. I'm not sure this exists in its most perfect form, but it does exist to some extent, and it's a good baseline for us to build. So market structures, how do we define the market that we're in? How do we collect its attributes and then determine what kind of a market structure we're functioning in? Well, there's 4 basic things we look for. How many suppliers are there? Is there 1? Is there 3? Is there 100? Is there 1,000? That's going to help us determine what kind of market structure we have. The second thing is the product's degree of uniformity. Are we all producing exactly the same thing? Or are you producing something that's a little different than what I'm producing? That's going to determine the market structure that we're in. Ease of entry and exit in the market. Is this an easy market for a new supplier to get into? Or is it an impossible market for a new supplier to get into? The fourth thing, do we compete as firms in this market? Compete in any way possible, whether it's pricing, whether it's advertising, do we compete at all? Depends on your market structure, right? And if we can figure out the answers to all of these questions, make a list of these attributes, I can tell you what kind of a market structure you're in, and then we can talk about what you need to do to profit maximize. A firm's decision about how much to produce or the price to charge depends on the structure. So it's really important for you to identify what kind of a market structure you're in. It's one of the first things that you do. Okay? All right. So we know we're in perfectly competitive market structure when we go through those 4 attributes and we list out the attributes here. We say that's a perfectly competitive marketplace. So first thing is there's many buyers and sellers. How many is many? It's a lot. What do you mean by a lot? It's so many that not one buyer or one seller really, in and of themselves, impacts the market at all. The market's so diluted with suppliers and consumers that not one supplier or consumer matters much at all. Firms sell a commodity. A commodity means we're selling exactly the same thing. Our example for this chapter is going to be a bushel of wheat. You and I don't differentiate bushel of wheat A from bushel of wheat B, and neither do most producers who then buy that wheat and go turn it into something else. It's a commodity. We're all essentially selling the same thing. You probably feel the same about a lot of agricultural products. Organic's its own thing, right? But for the most part, you and I view tomato, egg, soy, it's a commodity. It's pretty much generally the same. Buyers and sellers are fully informed regarding products and resources. What this basically boils down to is, as a buyer, I know what the selling price of that commodity is. It's a going price. It's pretty standard. We're selling a standard good at a standard price. Sellers know that they're selling a standard good at a standard price, and they all have about the same cost structures. They're all paying about the same for seed and water and fertilizer, etc. Firms and resources are mobile. This speaks to the ease of entry and exit in and out of these markets. It's very easy. easy to get in, it's easy to get out. If you think about farming wheat, selling wheat, you can plant it in your backyard, right? Anybody can really start growing wheat at any time along with other agricultural crops. Something else that might fall in this market structure would be an ounce of gold, a share of stock, something that's going to have a pretty standardized price. Demand under perfect competition. As a firm in a perfectly competitive market, you are what we call a price taker. You're a price taker. What that means is that the market, all suppliers, all consumers come together, give us the market, that the market determines the price in which we get to sell our goods. That we have very, very little influence at all, if any, over the price we get to sell our product at. So the market determines the price. I'm going to show you graphs on the next slide that I think will be helpful. Suppliers pricing above the market will sell no product. Standard good at a standard price. Try and sell your good for a higher price, nobody's going to buy it. Everybody knows a standard price. The demand curve facing the individual supplier, not the market, the individual supplier is a horizontal line at the market price. We looked at this when we talked about price elasticities. This is what we call a perfectly elastic demand curve. Perfectly horizontal, perfectly elastic. What it implies is that a good has one price. If you try and price above, demand would go to zero. Good. Perfect responsiveness by consumers to a change in price. Firms are called price takers. You already know that because they take the price or leave it. You either sell your good at that price or get out of the market, get into something else. And there is no competition between firms. You do not see marketing for wheat farmers, apple orchards, right? There's a reason that there's no advertising, because you're all pretty much selling the same thing. There's no reason, okay? You're selling about the same thing at about the same price. Okay, so these are just the graphs that go with what we just talked about, okay? We have a market for wheat, downward sloping demand curve, upward sloping supply curve, exactly what we would expect to see. That determines the market price, which we also call equilibrium, right? It's equilibrium. So we have an equilibrium price of $5. The market decided that. And here is equilibrium quantity. As an individual farmer, an individual wheat producer in this market, you either have to accept the $5 price or find yourself a different market. So when you're thinking of the demand curve you face, the demand for your good, your specific good, what you're actually looking at then is a perfectly elastic demand curve at that market price. This is the market. This is your firm. Okay? I would ask an exam question that says something like, how do we find the demand curve for a perfectly competitive firm? You would say, well, it would find market price, and then that would become my perfectly elastic demand curve at that price for my firm, right? Translates. You're basically at the mercy of the market, right? To tell you what the price is. All right, so economic profit. We talked a lot about economic profit last week. Economic profit is revenue, that's the money coming in, minus explicit, those accounting costs, those cash transactions, and implicit costs or implied costs. Those are opportunity costs. We talked a little bit about that as well. Firms maximize profit by determining the quantity at which total revenue exceeds total costs by the greatest amount. All this is saying is that you have total revenue and you subtract total cost, what you would get is profit. All this is saying is you want to find the greatest gap, the greatest difference, the greatest distance between these two, and that's going to be your greatest profit. So we when you take total revenue and subtract out those costs, the place in which there is the greatest distance or the greatest difference is where you're going to have the largest profit. In a perfectly competitive market or perfectly competitive firms, all that you have left to determine, because price has been given to you, is what quantity you need to produce in order to maximize profits. There's nothing more important than profit maximization at this point, okay? This is the first chapter where we're really going to get down to that, figuring that out. All right, this looks like a lot of information. Just bear with me, okay? You've seen a lot of this before. You saw a lot of it last week. There's a couple new things in here, but they're not too complicated. This first column here has bushels of wheat per day. This is our data. As an individual wheat farmer, this would be our data. So bushels of wheat per day, we can produce anywhere between 0 and 16 bushels of wheat per day. That's our capability. This second column is our marginal revenue. What does marginal mean? It's a change. It's an addition, right? And so what's the change in revenue as we sell one more unit, one more unit, one more unit at $5 per unit? It's $5, right? So marginal revenue is $5 all across the board. It won't be like this for every market structure. This is the neatest, simplest market structure. What is total revenue? Well, let's multiply the quantity that we're selling times the price we're selling it at, $5, and we'll get the total revenue, the total money coming in. Here we have total cost. In this case, it's been given to us. We didn't have to calculate it. I would add my fixed plus my variable cost, and I would get my total. Okay? Marginal cost then would be the change in cost. What this is calculating is what just that additional unit of production adds to our total cost, our overall cost. So in this case, if we're thinking about unit 11, our total cost for producing 10 units is 40. Our total cost for producing 11 is $42.25. The change is $3.25. That implies that just unit 11 added an additional $3.25 to cost, or cost us an additional $3.25. Okay? Average total cost, just an average. We talked about this last week. Just take your total cost, divide by your quantity, and that'll give you your average total cost. Really important information, average total cost. And then we have economic profit and loss. Economic profit and loss, total revenue minus total cost gives me profit. So total revenue is 60, total cost is 48, total profit is the difference, it's a positive difference, or $12. You can see that everywhere along here, that's what we've done. We've taken total revenue, subtracted total cost to give us profit or loss. When we look at that last column, you can see that those first units of production actually resulted in a loss. Then we got to see a profit, and then we went back to loss again. This happens for most firms just like that. Usually we start out with some losses, so we're just trying to gain momentum, create efficiencies, and then we max out on profit, and then we actually go negative again. There's a lot of principles behind that, right? Any questions on this so far? Okay. So there is a reason that this is bolded, because this is where we maximize profit, okay? You're not going to see it on a chart like this from this point forward. We're going to start graphing all of this stuff, and that's what you're going to see, okay? What is the golden rule of profit maximization? We should produce the output. This is a quantity. That's what you find should produce the output at which marginal revenue is equal to marginal cost. There might be no more important sentence in microeconomics than that. You find your profit maximizing quantity or marginal revenue equals marginal cost. I actually jokingly told students a couple years ago that if they got it tattooed on their body, MR equals MC, they could use it on the exam. Someone took me up on that. I swear, she's still here. Okay. All right, but I'll extend the same offer. Or as close as possible. That's what you find here, right? And so when we come here, this really holds true more for graphing than for charts, and graphing is where we're going to go looking for that point of intersection. But let's look here. Unit number 12 brings in marginal revenue of 5, and the marginal cost associated with that unit is $4.75. What that tells me is just that unit brings in $4, and just that unit cost me $4.75. Do I want to produce and sell that unit? Brings in a positive 25 cents of profit. Sure, I want to make that unit. Okay? Let's go to unit number 13. Unit number 13, we sell for 5. That individual unit sells for 5, but that individual unit costs me $6.50. Do I want to make and sell that unit? That's bad business, right? And you can see every other unit below that, it's the same scenario, it just gets worse and worse, right? This phenomenon happens to most producers, okay? If you can find the place where that point of transition happens, where you go from marginal revenue above marginal cost to marginal revenue, to marginal revenue below marginal cost, if you can find that point of transition, which you can very easily on a graph, that's where you want to stop. Okay? All right, let's graph that. These are fun. You're going to like it. Okay, these are those graphs. Okay? This one's the easy one. The next one is slightly more difficult and exponentially more important. Okay? So we're going to look at two different graphs. We're going to put our totals on a graph. Totals. We're going to find profit. And then we're going to start putting our per unit numbers on a graph. Marginal revenue, marginal cost, average total cost. We're going to start putting all those per units on a graph. We'll do that down here, and we can find profit the same way. But it's much more useful. Okay? So up here I've graphed two lines or curves. The first one is total revenue. That's going to be the yellow one. I know it's kind of hard on this one, but the yellow is total revenue. For each unit I sell, I get $5 additional. So we would expect it to be upward sloping and a constant slope at that. We're selling all units for the same price. Then we have our red curve, which is our total cost curve. Can anybody tell me what fixed costs are by looking at this curve? How do you know 15? Perfect. Even when you're producing nothing, total cost is 15. Wherever your total cost curve starts, that's what your fixed costs are. Because those are the ones that don't go down, right? So you can see that at first we start out with a cost curve above our revenue line, then it dips below, and then it goes back above. Those are losses. When your cost is above your revenue, you're losing money. So that's what's happening here. You're losing money, which you already saw in the previous slide. And then you hit some quantity at which you start to make a profit, and then you start losing money again. It is only when your costs dip below your revenue that you can expect to be making positive profits. If you can, in that section where costs dip below revenue, if you can find the greatest vertical distance between those two, the greatest distance between those two, you can figure out where you're maximizing profit. And so here, we find that greatest vertical distance at 12 units. Does that sound familiar? Sure it does, right? This is the same data as the previous slide. It's all the same data. So 12 units, at 12 units, if we hit cost and go over, we see that our cost is $48 at 12 units. Then we go up to revenue. We see that revenue is $60. The difference between the two is $12. Again, that should sound familiar because that's what we found in the previous slide. Good? Easy enough? Okay. All right. This is that graph that we're just going to keep tweaking. We're just going to keep adding to this lecture and next week's lecture as we talk about different market structures. If you can wrap your head around this, you are golden for the next couple weeks, and you're good for the exam as well. So this is the one. If you don't get it, you need to make sure you get it before next week, okay? Because then we're just going to add on to it. So there are two curves on here that you've already seen. You saw them last week. This is simply the data from the previous slide. We've graphed it. So you can see an average total cost curve. It has a U shape. You know it does because you saw it last week. Here's a marginal cost curve. We just took all those marginal costs that we calculated in the previous slide, and we drew our marginal cost curve, which always looks like a check mark, right? And always intersects your average total cost curve at its minimum. Perfect, right? Because when your marginals are less than your average, it brings it down, and then when your marginals are greater than your average, it pulls it up. Okay? Everybody good? So far, so good? Okay. So the next thing we're going to do here is we're going to put our demand curve, our firm demand curve, on here because it holds a lot of data for us. Okay? And then we're going to try and figure out how to profit maximize. So right here, I have put on, sort of, ignore this for now. I've sort of put on my $5 perfectly horizontal demand curve. Okay? Now, there's also a couple of other lines that would sit in that same exact spot, except for they all cover each other up. Your marginal revenue line would lie under there, and an average revenue line would lie under there. You sell every unit for $5, what's your average revenue? $5. That's not right? Your marginal revenue, what's the additional revenue if you sell every unit for $5? $5, right? Wow, that sounds like an exam question too. What is your perfectly competitive demand curve also equal to? Marginal revenue and average revenue, right? That sounds like something I would ask. Let me put the screen up real quick so I can write it for you. Alright, so demand equals marginal revenue, which is also equal to average revenue in this case, in this market structure. Okay? So if I am given these three curves, lines, right? So I have marginal cost, I have my ATC, my average total cost, and I have my demand curve, which is also marginal revenue. There is a 3-step process that I am going to go to figure out my profit, to figure out my profit maximizing quantities. What's the golden rule? Because that's step 1. Find where MR equals MC, where marginal revenue is equal to marginal cost. Well, this is where my marginal revenue lies. My marginal cost is this check mark. Right here is where they intersect. What do I find at MR equals MC? What does it help me find? Quantity. That's all you find. That's all you find. So step 1, MR equals MC, tells me the quantity at which I profit maximize. In this case, that's 12. You already know it's 12, but we found it here too. Okay? Step 1. Step 2. Find your demand curve so you can determine your price. Well, coincidentally, our demand curve is in the same exact spot. It won't always be with every market structure, but the same 3-step process will always hold true for every structure. So I find my demand this case, I'm going to head down to my ATC. Is that a good sign? Yes. If you start at your price and head down to your ATC, it's because your cost is lower than your price. That means you're making a profit. You can see that's what we've done here. So because these are per unit numbers, we're going to calculate per unit profit. So you can see that our per unit profit is $1 times the number of units gives me my total profit. All comes full circle, right? Once you find MR equals MC, once you find this profit maximizing quantity, do you care about anything on this graph except for what's happening right along this plane that your profit maximizing quantity? Why would you? It's your profit maximizing quantity. All the data you need sits right there. I get a lot of students that start crawling over here trying to find numbers. It's right here. It's all right there. Ignore everything else on that entire graph, every other part of every curve. Because once you find that, who cares about anything else? Questions? You memorize those 3 steps, I promise you they will never do you wrong. Ever. Okay? I will give you graphs like this on your exam. And I will just start asking questions. What is the ATC per unit at your profit maximizing quantity? $4. What's your total cost at your profit maximizing quantity? Well, it's $4 per unit times the quantity. What's 48? There's so much data. There's so much data here, right? That I should be able to ask you totals per, I should be able to ask you anything on this graph and you should have no problem finding it for me. Okay? Just start collecting those little pieces of data. No questions? All right, just come back to it. Just spend time with it. Just look at it and make sure you understand it. We're going to tweak it a little today. We're going to do a lot of that next week as well. All right, moving on. Okay, this is just what we already talked about. Marginal revenue equals marginal cost. There's nothing new here. This is just us coming full circle with the profit maximization. In perfect competition, marginal revenue is equal to the market price. Hence, the demand curve that sits right at the revenue line, marginal revenue line, right? Those sort of sit on top of each other, if you will. Firms increase production as long as marginal revenue exceeds marginal cost. That was us working down that chart. Remember, we went from 12 to 13. And as soon as we got to 13, we went, wait. Right? Marginal cost exceeded revenue. And that's not a good thing. And there's just your golden rule again. Just make sure you know it's always the golden rule. It's always, always, always for every market structure. Okay? All right, let's talk about firms who lose money. Okay? This is an interesting concept in that I don't think we always think about this. Is that a lot of times when firms go to make these calculations, they're not making any positive profits. They're not making any money. They're actually losing money. And so what they're trying to do is deal with a totally different consideration. How do I minimize losses? Not how do I maximize profit, but how do I minimize the amount that I'm losing? We can use the same data, we can use the same graphs, we can use all of that same stuff when we're trying to help a firm minimize their losses. Are there firms that run negative for a portion of every single calendar year? Absolutely, right? It happens all the time. It happens in Flagstaff all the time. Because we have seasons, right? So the Snow Bowl runs a loss until they start selling you ski and snowboard passes, right? What do those sell for? A lot, right? Every time I go up there, I'm just dumbfounded, right? I mean, I think they're close to $80. But during the summer, if you want to ride the chairlift operation is fixed costs. There are times in which you are experiencing losses as a company, but you should continue to operate, at least for right now, because it's going to help you minimize losses. So let's say I started a little company, and I make t-shirts. I sell them for $10 a piece, and on average, I sell 10 a day. I have fixed costs, okay? Well, my total revenue is approximately $100 a day. My fixed costs, because I rent a space somewhere or some sort of a screen printing machine, whatever, my fixed cost is $60, so I have to pay it every day, right? And then let's say my variable cost, which would be the t-shirts themselves, the ink, whatever, if I'm paying someone labor in order to do this, whatever. Let's say my variable cost is $7 per unit, which means I'm spending $70 in order to make those 10 t-shirts. What's my profit every day? It's negative. Negative 30, right? If I take my revenue and I subtract out my costs, it's a negative $30. Many people would say, you need to shut down, right? This isn't working. And I say, I should continue to operate. Because if I shut down, what's my cost? What's my loss? What? It's my fix, right? Because I likely have myself in some sort of a lease or a contract or something to rent that space, lease that equipment, whatever. So if I shut down, my loss is $60. If I continue to operate, it's $30. At least right now I should continue to operate. When my lease expires, I got a totally different decision to make, right? Yeah, I might want to shut down. I can't tell you what this person should do in the long run, but I can tell you right now, she should continue to make t-shirts. Okay, does everybody understand that? It's a function of your fixed costs. They're fixed. You can't get rid of them right now. One day you can, but not right now. Okay? All right. Firms produce rather than shut down if total revenue exceeds variable costs. Total revenue exceeds variable costs, you should continue to operate. Because the difference can then be applied towards fixed costs, can contribute to the fixed costs. If production helps cover any portion of the fixed costs, a firm is better off producing in the short run. Firms produce rather than shut down, where the price at least covers ABC. If the price at least covers ABC, you should continue to operate. This is the marginal analysis, the per unit analysis, but you can see it works out the same.
When you say covers, does that mean it would just come out to zero?
If it covered it, but if it just contributes to it at all, we're going to continue to operate. But yeah, if you were able to cover all of it, like in this case, let's say this was $30 and it came out to zero, yeah, then it would cover all my fixed costs. That would be a decent scenario.
I think, I don't know if you were asking this too, but if the price was actually $7 and the variable cost was $7, and those broke even.
Got you. Is that what you were asking? Maybe. Okay. So what you're saying is, let's change this to 10. Yeah. I know what you're asking. And it's legitimate. We're actually going to come around to it. So let's say this is 10, so this is 100, right? So it's the same either way. Yeah. We'll call that our shutdown point. I'm actually going to show you a graph and we're going to talk about shutdown. But yes, you could continue to operate or you could shut down. It would be the same. Yeah, but you have that choice. Yeah. Shutting down in the short run, if average variable cost, so let's say this is 11, not 10. Okay, let's say that's 11. If average variable cost exceeds the price at all rates of output, the firm will shut down. So you can see that this changes everything, right? Because if we change this to 11, if variable cost was greater than price, we would actually have a negative 70 here. You should shut down, okay? Because you minimize your losses by shutting down and not continuing to operate. So it's really dependent on fixed cost and variable cost whether you should continue to operate or shut down, okay? All right, we're gonna look at these two graphs again. Virtually the same two graphs with the same data, except something changed, okay? The price changed. If you are in a perfectly competitive market structure, are you subject to price change all the time? Yeah, the market can change the price anytime a demand or supply curve shifts. Your price could change. And because you're a price taker, you just have to accept it. So one day you could be making profits, and one day you could be seeing losses. It depends on what's happening in the market because you're a price taker. So we're a price taker, so our price changed from $5 to $3. Our cost curve is exactly the same as the last one you saw. The difference is this total revenue curve is much lower than it was before. What's happening? It's a loss, right? This entire point, you are never at a point where you're making profit. You are never at a point where your revenue exceeds your costs. So it's just negative. If you can find the smallest vertical distance between those two in this type of scenario, you're going to figure out where you minimize losses. Coincidentally, it's the same three-step process when we look at this next graph. That you find profit maximization and loss minimization at the same place. So the nice thing is you just go looking and you're going to figure out your situation. Okay? All right. So in this case, we find loss minimization at a different quantity, of course, right? 10. And we find the smallest vertical distance, which we've done. And we head across over to dollars, we can see that the minimum we can make our losses is $10. Okay, so now let's look at the marginal analysis for this other graph. We got it a curve you've seen before, you saw last week, and that's your ABC or average variable cost. Because we're losing money, this is an important curve to add on here. Okay, we already know we're losing money. So, we have our three curves. In the previous graph, you only saw these two, your MC and your ATC. We've added the ABC because you'll need it. So, instead of drawing our demand curve at $5 way up here like we did last time, we got to come way down here. And let's go through our three-step process. We find where marginal revenue equals marginal cost. That happens right here. That gives us, in this case, it's not profit maximizing, it's loss minimizing. Okay? So, step one, step two is find your demand curve so you can find your price. Good, that happens right here. And the next thing, step three, is what? Find your ATC, your average total cost. In this case, I have to go up from price. That means I'm in trouble, right? I'm losing money. If your costs are above your price, you're losing money. So I've done that. And then if you measure those across, you'll see, right? All the data you need lies right here. You'll see that your price is $3. Your ATC, or average cost per unit at that quantity, is $4. Difference is a loss of $1 per unit times 10 units. That's your $10. Should I shut down or continue to operate? What's that? Did I hear something?
I said after the cost is 250, so that you want to
Perfect. curve, but of course the only point we care about on it is right here. It's less than your price. This, what does this represent? This gap right here between your ABC and your ATC?
Your fixed.
Your average fixed cost. Good. Average variable plus average fixed gives you average total. That makes sense, right? So if this is your average fixed, is this vertical distance, you are covering this portion of your fixed. That's a good thing. You should continue on, right? As long as your price is above your ABC, you should continue to operate. We're going to look at this again, okay? But it's all of those principles sort of wrapped up into one block. I'm going to skip this. You don't want this yet, okay? We're going to go to this. You want to take copious notes on the screen. You want to write down everything I say. There is so much good information here, okay? We're starting with the three curves that you're going to see over and over again that you should understand what you're looking at here, okay? The simplest of all the curves. You've taken a couple of averages, ABC, ATC, good stuff. That marginal cost, that additional cost, that change in cost from producing another unit, that's good stuff too. They'll basically, at least for the sake of this class, always have the same orientation to each other. They'll always sort of look the same, okay? Obviously the ABC is going to sit under the ATC, and the marginal cost, that check mark, is going to intersect them both at their minimum points. We are going to start talking about what price one means to this firm. We're at the mercy of the market. We have to think about how prices could change and what that means to us. We're going to talk about what price 2 would mean to us, price 3, price 4, price 5. That's good information. You should know that. You will likely see something like this again. Okay? So let's talk about price 1. You're this firm, the market comes back and says, we are going to give you price 1 for your good. How do you feel about that? I see you shaking your head now. What don't you like?
Below all the costs.
What's that?
Below all the costs.
It's below all the costs, right? So this doesn't even cover your ABC. You do not want to produce a single solitary unit at price 1. Price 2. This is actually what we were having the discussion about earlier, okay? At price 2, you've hit this interesting point of intersection here that we call your shutdown point. It means you're just covering your ABC, right? This is when we had the 60 and the 60 here. You're just covering your variable cost, and what you have left is your fixed. I believe there's a homework question. It's a little tricky, okay? When you are talking about this point right here, you have a choice. You could shut down or you could continue to operate. It's the same loss, right? Why might you continue to operate and not shut down?
Price going to change.
Your loss is going to be the same
Price point fluctuate depending on the market.
because you feel like the price is going to go. There's some indicator that you think that the price is going up and you're just going to hang out. You're just going to hang out and wait for the price to go. That's the only incentive to continue to operate, unless it's an incentive like, I don't want to lay all my people off. As long as I'm going to lose the same either way, let's just keep everybody employed. Something like that, right? There's a couple things you might do there, but it's usually because you have an expectation that things are going to get better, okay? On exams, a lot of students want to tell me that point 1 is the shutdown point. It is not the shutdown point. Would you be shut down at point 1? Absolutely. But it is not your shutdown point. You would actually, any price below P2 would actually be it a shutdown decision for you. This is your shutdown point. It comes at the intersection of ABC and your marginal cost. Good? Okay. Price 3. What's happening in price 3? Profit or loss?
Still lost, but you're covering a portion of
Beautiful. Yes, a portion of your fixed costs. Perfect. Okay? This was the situation we just had with that $3 price, right? We're experiencing a loss, but our price, our demand curve, is still above our ABC, which means we're covering a portion of our fixed costs. We should continue to operate in the short run. What should we do in the long run? You don't know, I don't know. We got to cross that bridge when we get there. Okay? All right. Price 4, break even. Okay? It's where your price is exactly equal to your cost, your ATC. This always happens at the intersection of the ATC and the marginal cost curve, point 4. At that corresponding price is your break even. You're just covering all your costs. Okay? So that would be a 0 in terms of profit or loss. Any price above that is a positive profit for you. Okay? That includes price 5, but any price between 4 and 5 also constitutes a profit for you. So when you look at these curves, even if I just give you the 3 curves, you should be able to tell me the scenario that goes with any single price I give you, right? Depending on that price's orientation to the curves. Can you imagine for a firm, you have these 3 curves, and every time the price changes, you can just be like, loss, but continue to operate? Like, all the data's there for you. That's good stuff. Okay, that's high-level management, that's high-level decision-making at every firm looks something like this. So, I know some of you think this isn't relevant to you. This just makes you more valuable as an employee, as a manager, as an owner, right? How many people in the world do you think know this? Not very many. Okay? Yep.
So when you hit the break-even point, is that something where you would want to operate in the short run and long run, or like in the long run?
That's a great question. I think it depends on what you think is going to happen to prices. Yeah. If you see prices continuing to go up, or that's what you would expect, yeah, you probably want to stay in it for the long run. Yeah, it's a great question. Hard to say. Any other questions on this? This is good stuff. Okay? Now, a dark red line is going to show up on here. And then we're going to backtrack to the previous slide I'm going to take a look at. Let me do a quick time check. Okay. What we have drawn here, and I know you have a homework question that deals with this, so you're going to want to pay attention, take some notes, because a lot of students got freaked out with this homework question. This dark red line that traces the marginal cost curve from the shutdown point up is actually your firm's supply curve. Your firm's short-run supply curve. Let's think about the definition of a supply curve. It's the prices and the quantities that you are willing and able to produce at those prices. Well, coincidentally, that's what we've actually found here at 2, 3, 4, and 5. Will you produce anything below 2? No, so that part of the marginal cost curve falls out. And from this shutdown point up, it's upward sloping. That's what we'd expect to see, right, from a supply curve. And how do we find the quantity that you should supply at every price, the profit maximizing or loss minimizing? We find M equals MC. And so marginal revenue meets marginal cost right here at this price. Marginal revenue meets marginal cost right here at that price, so on and so forth. So what you've really done is created your firm's short-run supply curve by drawing out that marginal cost. I'm going to back up one. You're just going to see that written out, okay? I just wrote it on a slide because I thought it would be helpful, okay? The short-run firm supply curve, the portion of the firm's marginal cost curve that rises above the lowest point on the ABC, right, that point of intersection, also known as your shutdown point, becomes your short-run supply curve. The short-run industry supply curve, this is where your homework question comes in, is the horizontal, looking this way, horizontal sum of all the firm's short-run supply curves. For example, okay, if we go forward again to look at our graph, okay, I know that one firm in this perfectly competitive market has a short-run supply curve that looks like this. If all firms in the market have similar cost curves, they probably do, it probably costs similar amounts to produce wheat for every farmer, right? It's pretty standard. How I would figure out the industry supply is if there were, let's say, 20 firms in the industry, if I knew there were 20 farmers making wheat that all had about the same cost, I would figure out the quantity that one farmer would produce, and I multiply it by 20. There's 20 farmers, all producing about the same at the same cost. Does that make sense? So at this price, at P2, my price still stays the same. So at P2, I would take the quantity that one produced, I would multiply it by 20, and I would replot that. Then I would go to price 3, I would find the quantity that one would produce, multiply that by 20, replot that. It's going to look about the same, it's just going to be way over here because the quantity is going to be larger. Does that make sense? Prices are the same, the quantities change. So I believe your homework question has you do that for 20 firms, 30 firms, and 40 firms. Don't overthink this, okay? What one would do times 20. What one would do times 30, what one would do times 40. And it has you plot those on the same graph. Just do your math, right? Multiply by the 20s, graph them, 30s, graph them, 40s, graph them. It's something like that. Does that make sense to everybody? Don't overthink that, okay? All right, let's talk about perfect competition in the long run. This is where that entering and exiting the market easily attribute that we talked about at the beginning of the lecture, that's where this comes into play. It is very easy for firms to enter and exit markets in perfectly competitive market structures. So let's think about being a wheat farmer. You are a wheat farmer and you are losing money producing wheat, but they are making money in the soy market producing soy. What might you do? Move to the soy market. Because it's easy to exit wheat and it's easy to enter soy. Okay? Because of that, we find a lot of movement in perfectly competitive market structures. We find that firms will run away from losses and run towards profit anytime. When a wheat farmer leaves the wheat market, what happens in terms of the supply curve? The supply goes down, shifts. Which way does it shift? To the left. Shifts to the left. Do you know what happens to price when you decrease supply in a market? It goes up. You drew a little graph, right? But it goes up. Well, that's funny. You just left a market that was losing money, and by you leaving, the price went up. And so perhaps the existing farmers who stayed aren't losing money anymore. Does that make sense? Now you've gone into the soy market, which was making profits. What happened to the supply curve in the soy market once you entered? It went up, shifted to the right, which brings the price down. So this funny thing happens in perfectly competitive markets, is that very easily firms leave when they're experiencing losses. They go enter markets that are experiencing profits, and in the long run, everybody evens out. There's no losses left to run away from. There's no profits left to chase. Everybody sort of sits still because there's nothing left to do. We call that the equilibrium in perfectly competitive markets, and everyone is earning zero economic profit at that point. What's that condition called? Normal profit. Normal profit. Okay? Does your accountant still say you're making a positive profit? Yes, they are. Because what costs don't they consider? Implicit. So they haven't even subtracted those yet. So your accountant is saying you're still producing a profit, but there's no place else you could go that you could earn more of a profit. Your economic profit is zero. That's okay. Economic profit is zero is okay. Okay? It's all you can really hope for in perfectly competitive markets. Not all market structures look that way, right? This is just perfect competition. So firms enter and exit markets, whether they're running away from losses, chasing profits, whatever they're doing, or even if you stay in the market and don't leave it, maybe you might make less or you might make more, depending on whether there's profits or losses, right? So adjust your scale of operation. And because all resources are variable in the long run, we move around, nothing's fixed, we can do this, and we end up with that zero economic profit. This is just a description of what we talked about, okay, with the supply curves. If you're making an economic profit in the short run, new firms will enter the market, right? That shifts the supply curve. Market supply will increase. Price decreases, the economic profit disappears, and we end up in that equilibrium or zero economic profit, break even, if you will, in the long run. So the question is, how much profit? There's something like a worksheet, right? About the potential of perfectly competitive firms to earn a profit in the long run. What's their potential? Zero economic. They cannot earn a positive profit, and they'll run away from losses too, so they won't have any losses. Everybody's going to see those. This is the opposite scenario about losses and firms leaving the market or decreasing their scale of operation. If they decide to stay, they'll just make less. And this is about that break even as well. Bless you. I'm going to skip this. Bless you. That's basically a summary. This is a draft summary. We're not going to talk about that. Okay. So now that we're in this nice, beautiful equilibrium, everybody's earning zero economic profit, nobody has any incentive to go anywhere else. The only thing that could disrupt that, the supply curve's not shifting, nobody's going anywhere. What might shift and disrupt equilibrium? What's that? It's demand. You'll change your mind about something and disrupt the market. Have people decided in recent years they don't want to eat as much wheat? Yeah, right? We have all these intolerances and things like that that have decreased the demand for wheat. You do that all the time in markets. Now we've disrupted this equilibrium, okay? Because the demand curve has shifted. And so what happens then is we now have markets that are experiencing losses, we're experiencing profits, and then we see that whole movement happen again, okay? So the effects of an increase in demand in the short run, the price will increase. Firms increase quantity supplied and see an economic profit. In the long run, we'll see that movement again. This is from the previous slide that we just saw, right? Because there's an economic profit, firms will enter the market, supply will increase, which reduces the price, and we'll circle right back to normal profit. But that's the thing that disrupts that equilibrium, right? Is the demand curve shifts, which changes the price, which changes the scenario in terms of profit. Yeah. I'm going to to show it to you on a graph. I think it makes a whole lot more sense that way, okay? When you and I participate in markets as buyers, you and I end up with something that we call consumer surplus in most cases. This is like you walking into the grocery store with $3 in your pocket, intending to buy a gallon of milk. You get in there, it's on sale for $2.50. Willing to pay $3, only had to pay $2.50, that 50 cents is what we call consumer surplus. It's the difference between what you had to pay and what you were willing to pay. This happens to us all the time. What are you and I going to do with that 50 cents left in our pocket? We're going to buy something else, right? We're going to buy something else. That's good for an economy. Consumer surplus is good for an economy, puts money in consumers' pockets. We're not big savers, so we turn around and we spend that money, right? So on a graph, that is depicted by this triangle here. This is what consumers had to pay for the good, $10. And every consumer on this portion of the demand curve that rises above $10 was willing to pay more. They didn't have to, right? So that triangle there, good for society, good for an economy. We call it positive social welfare. It's good for society, okay? On the flip side of that, something we call producer surplus, okay? We talked about how the supply curve doesn't go all the way to the origin, right? We're just going to make a quick jog over towards the starting price here, just to box in that area. We call that producer surplus. There were producers willing to sell us this good at a lower price than $10, but they didn't have to. They got $10. That's good for producers. Is it good for producers in an economy to make profits? Yes, right? You hire more people, you expand your operation, you buy more resources, all that good stuff happens. This is all good. Positive social welfare all over. Yep.
So the producer surplus is regarding money?
It's all money. It's all money.
Okay.
Yeah, it's all money. This is money left in producers' pockets that were willing to sell. Like somebody was willing to sell this good for $5, but they got 10. So they got $5 in consumer surplus left as profit. Okay? This is really basic at this point. We're going to double back to this, especially when we talk about international trade. Restricting international trade does one primary thing to the consumers in that country. That's us, okay? So when we talk about restricting trade in this country, it's fine, right? People have their own opinions, and that's fine. But from an economic perspective, the takeaway is you're going to lose consumers. You're going to pay a higher price. You're going to have less money in your pocket to spend on other things. And when you have less money in your pocket to spend on other things, the whole economy retracts. Okay? Again, this isn't a political class, right? It's an economics class. But when we come back to international trade, that's what you and I are going to talk about, is how tariffs and quotas and restricting trade in this way, how it erodes your consumer surplus. Okay? All right.